Welcome to our comprehensive guide on bookkeeping and accountancy. In this video, we'll explore the foundational concepts, objectives, and importance of bookkeeping, as well as the differences between bookkeeping and accountancy. We'll also cover essential accounting terminologies, concepts, conventions, and standards, including the latest international frameworks. Whether you're a student, business owner, or just curious about how financial records are maintained, this video will provide you with a clear understanding of the subject. Let's start by understanding what bookkeeping is and why it matters in the world of business. Bookkeeping is the process of recording business transactions in a systematic and organized manner. Every business, whether large or small, deals with numerous transactions involving the exchange of money or money's worth. Bookkeeping ensures that all these activities are documented, providing a reliable record for future reference and decision-making. It's not just about writing numbers in a ledger, it's about creating a permanent, accurate record that forms the backbone of any business's financial information. This process is crucial for understanding the feasibility and profitability of business operations. Keeping is essential for more than just keeping track of money. It provides vital information to business owners, managers, investors, and even government authorities. Accurate records help in assessing the financial health of a business, making informed decisions, and fulfilling legal requirements. Without proper bookkeeping, it would be nearly impossible to determine profits, losses, assets, or liabilities. Moreover, bookkeeping serves as evidence in legal matters and helps in calculating tax liabilities. In short, it's a critical tool for business growth and transparency. Accounting has a rich history that dates back centuries. In ancient India, references to accounting can be found in Kautilya's Arthashastra. Over time, accounting evolved from simple record-keeping by property agents to the sophisticated double entry system introduced by Luca Pacioli in 1494. The Industrial Revolution further expanded the need for detailed financial information, leading to the development of management accounting, and more recently, social responsibility accounting. Today, accounting is an indispensable part of business, adapting to the growing complexity of economic activities. Bookkeeping is often described as both an art and a science. It involves the systematic recording, classifying, and summarizing of financial transactions over a specific period, usually a year. Several experts have defined bookkeeping in their own words, but the essence remains the same. It's about accurately documenting every business dealing that involves money. This ensures that the financial position of a business can be assessed at any time, and that records are available for analysis, reporting, and control. Keeping has several distinguishing features. It records only financial transactions, ensures that all entries are made for a specific period, and follows established rules and regulations. The process is scientific, aiming for accuracy and reliability. By maintaining daily records, bookkeeping provides a permanent reference for future needs. These features make bookkeeping a vital part of any business's financial management, ensuring that information is always available when needed. Main objectives of bookkeeping are to maintain a complete and accurate record of all financial transactions, ensure that entries are made date-wise and account-wise, and serve as evidence whenever required. Bookkeeping also helps determine the profit or loss of a business, assess assets and liabilities, and compare financial progress over different periods. By achieving these objectives, bookkeeping supports effective business management and strategic planning. Bookkeeping is important for several reasons. It helps maintain a permanent record of all transactions, provides financial information for decision-making, and enables business owners to control operations. Bookkeeping also serves as legal evidence in case of disputes and is essential for calculating tax liabilities. Its utility extends to various stakeholders, including owners, management, investors, customers, government, and lenders, all of whom rely on accurate financial information for their respective needs. While bookkeeping focuses on recording and classifying business transactions, accountancy goes a step further by summarizing, analyzing, and interpreting financial data. Bookkeeping is the primary stage, forming the foundation for accounting. Accountancy includes preparing financial statements and communicating results to relevant authorities. The responsibilities also differ. Junior staff typically handle bookkeeping, while senior staff manage accountancy. Understanding these differences is crucial for appreciating the broader scope of financial management. Accountancy is the entire body of theory and process behind accounting. It involves recording, classifying, and reporting business transactions, and is based on universally accepted accounting principles. Accountancy ensures that financial information is collected, summarized, analyzed, and reported in monetary terms. This practice is essential for businesses to communicate their financial results to various stakeholders and make informed decisions based on reliable data. There are three main methods of accounting: cash basis, accrual or mercantile basis, and mixed or hybrid basis. Under the cash basis, only actual cash receipts and payments are recorded. The accrual basis records revenues and expenses when they are earned or incurred, regardless of when cash is exchanged. The mixed basis combines elements of both, but is generally not permitted under Indian law. Understanding these methods is key to interpreting financial statements correctly. Accounting information must possess certain qualitative characteristics to be useful. These include reliability, relevance, understandability, and comparability. Reliable information helps users make sound judgments, while relevant information influences decisions. Understandability ensures that users can interpret the data, and comparability allows for meaningful analysis across different periods or entities. These characteristics make accounting information valuable for decision-making. Reliability means that accounting information can be trusted for making decisions. It varies depending on the type of information, with some items being more reliable than others. Relevance, on the other hand, ensures that the information provided is useful and can influence business outcomes. Only information that can make a difference in decision-making should be included in financial reports, ensuring that users focus on what truly matters. Understandability ensures that accounting information is presented in a way that users can easily grasp its significance. This widens the circle of people who can benefit from the data. Comparability, meanwhile, allows users to compare financial information across different periods or organizations, helping them identify trends and make informed choices. Both qualities are essential for effective financial communication. Understand accounting. It's important to be familiar with basic terms. These include transactions, capital, drawings, debtors, creditors, assets, liabilities, and more. Each term has a specific meaning and plays a crucial role in the accounting process. For example, transactions refer to exchanges involving money or money's worth, while capital is the amount invested by the owner. Knowing these terms lays the foundation for mastering accounting concepts. Transactions in accounting can be monetary or non-monetary. Monetary transactions involve the exchange of money or money's worth, such as cash or credit sales. Non-monetary transactions like barter exchanges do not involve money directly. Only monetary transactions are recorded in the books of accounts, ensuring that the financial records reflect the true economic activities of the business. Capital refers to the total amount invested in the business by the owner. It represents the excess of assets over liabilities and is considered a liability of the business to the owner. Drawings, on the other hand, are amounts withdrawn by the owner for personal use. These concepts are important for understanding how owners' equity changes over time and how personal and business finances are kept separate. Debtors are individuals or entities who owe money to the business, usually because they have purchased goods or services on credit. Creditors, in contrast, are those to whom the business owes money for goods or services received on credit. Understanding the distinction between debtors and creditors is vital for managing cash flow and assessing the financial position of a business. Expenditure in business can be classified as capital, revenue, or deferred revenue expenditure. Capital expenditure is spent on acquiring or improving fixed assets and provides long-term benefits. Revenue expenditure covers day-to-day operating expenses with short-term benefits. Deferred revenue expenditure is revenue in nature, but its benefit extends beyond 1 year, such as heavy advertising costs. Proper classification helps in accurate financial reporting. Discounts are concessions given by sellers to buyers. Trade discounts are reductions on the list price at the time of sale and are not recorded separately in the books. Cash discounts are given for prompt payment and are recorded as expenses or income. Understanding the difference between these discounts is important for accurate accounting and reporting. Person or business is considered solvent if their assets are equal to or greater than their liabilities, meaning they can meet all their financial obligations. If liabilities exceed assets, the person or business is insolvent and may not be able to pay debts. This distinction is crucial for assessing financial health and risk. The accounting year is a 12-month period for which accounts are maintained and closed. In India, the financial year runs from April 1st to March 31st. At the end of the accounting year, businesses prepare key financial statements like the trading account, profit and loss account, and balance sheet to assess their financial position. Trading concern is a business established to earn profit by selling goods or services. In contrast, a not-for-profit concern is set up to provide services to society, such as schools, hospitals, or clubs. Understanding the difference helps in recognizing the objectives and accounting practices of different organizations. Goodwill is an intangible asset representing the reputation and other non-physical attributes that contribute to a business's earning capacity. It arises from factors like favorable location, skilled employees, and customer satisfaction. Goodwill is valued in monetary terms and can enhance a business's overall worth, even though it's not a physical asset. Profit occurs when the selling price of goods exceeds the cost price, increasing the business's capital. Loss is the opposite, reducing capital. Income refers to revenue generated from business activities including sales, interest, and commissions. Revenue is the income from normal business operations. These concepts are fundamental for evaluating business performance. Assets are resources owned by a business that have monetary value such as land, equipment, or patents. Liabilities are amounts owed to others like loans or outstanding expenses. Net worth or owner's equity is the excess of assets over liabilities. Understanding these terms is essential for interpreting balance sheets and assessing financial health. Assets can be classified as fixed, non-current, current, or fictitious. Fixed assets provide long-term benefits like buildings or machinery. Current assets are easily converted to cash within a year, such as inventory or receivables. Fictitious assets are not tangible but are recorded for accounting purposes like deferred expenses. Proper classification aids in accurate financial reporting. Liabilities are categorized as fixed or current. Fixed liabilities include long-term obligations like loans or capital, while current liabilities are short-term debts payable within a year, such as creditors or bills payable. Recognizing these distinctions is important for managing business finances and meeting obligations on time. Contingent liabilities are potential obligations that may arise depending on the outcome of a future event, such as a pending lawsuit. They are not shown on the balance sheet but are disclosed as a footnote. This ensures transparency and informs stakeholders about possible future risks. Accounting concepts are fundamental ideas that guide the recording and reporting of financial transactions. They ensure that financial statements are reliable, consistent, and comparable. Key concepts include business entity, money measurement, cost, consistency, conservatism, going concern, realization, accrual, dual aspect, disclosure, materiality, and matching. These concepts form the backbone of accounting practices worldwide. Business entity concept treats the business as separate from its owner, ensuring that only business transactions are recorded. The money measurement concept states that only transactions measurable in monetary terms are included in the accounts. These principles help maintain clarity and objectivity in financial records. Cost concept records assets at their original purchase price, not current market value. The consistency concept requires that accounting methods remain unchanged from one period to another unless a change is justified and disclosed. These concepts ensure stability and comparability in financial statements. Conservatism concept advises accountants to anticipate no profits but provide for all possible losses, ensuring that financial statements are not overly optimistic. The going concern concept assumes that the business will continue operating in the foreseeable future, affecting how assets and liabilities are valued. The realization concept records income only when it is earned, not necessarily when cash is received. The accrual concept records revenues and expenses when they are earned or incurred, regardless of cash flow. These principles ensure that financial statements reflect the true financial performance of a business. The dual aspect concept states that every transaction has two effects, forming the basis of double entry bookkeeping. The disclosure concept requires that all material information be presented in financial statements, ensuring transparency and honesty in reporting. The materiality concept ensures that only significant information that could influence decisions is included in financial statements. The matching concept matches revenues with related expenses in the same accounting period, providing a clear picture of profitability. Accounting standards are written policies and guidelines that standardize accounting practices, ensuring consistency, comparability, and reliability in financial reporting. In India, the Institute of Chartered Accountants of India, ICAI, issues these standards, which cover recognition, measurement, presentation, and disclosure of accounting transactions. Accounting standards are necessary to promote a better understanding of financial statements, help accountants follow uniform procedures, facilitate comparison between entities, enhance reliability, and meet legal requirements. They form the foundation for transparent and trustworthy financial reporting. International Financial Reporting Standards, IFRS, are global accounting standards issued by the International Accounting Standards Board, IASB. IFRS aims to harmonize accounting practices worldwide, making financial statements more comparable and transparent across countries. In India, IFRS convergence has led to the adoption of IND AS for larger companies. India, the Accounting Standards Board ASB under ICAI formulates accounting standards, considering local laws, customs, and international practices. The convergence with IFRS has resulted in IND AS, which are mandatory for large companies. Smaller businesses may continue using traditional AS, but a shift to IND AS is expected in the future. Important accounting standards include AS1 disclosure of accounting policies, AS2 valuation of inventories, AS3 cash flow statements, AS6 depreciation accounting, AS8 research and development, AS9 revenue recognition, AS10 fixed assets, AS12 government grants, AS13 investment, and AS22 taxes on income. Each standard addresses specific aspects of accounting, ensuring clarity and uniformity. AS1 requires that all accounting policies used in preparing financial statements be disclosed in one place. This transparency helps users understand how financial information is prepared and ensures consistency in reporting from year to year. AS2 states that inventories should be valued at the lower of historical cost or net realizable value. This ensures that assets are not overstated and that financial statements reflect a realistic view of the business's resources. AS3 requires businesses to prepare a cash flow statement for the same period as the profit and loss account. This statement provides insights into the cash generated and used by the business, helping stakeholders assess liquidity and financial flexibility. Summary: bookkeeping and accountancy are essential for recording, analyzing, and reporting business transactions. Understanding the key concepts, terminologies, methods, and standards ensures accurate and reliable financial information. As businesses grow and regulations evolve, staying updated with the latest accounting standards and practices is crucial for success. Thank you for joining us on this journey through the fundamentals of bookkeeping and accountancy.